Hello and welcome to this week's instalment of Nucleus Investment Insights. This week our attention moves to the recent David and Goliath share market battle between retail investors and a couple of hedge funds over the US video gaming retailer Gamestop and movie theatre company AMC Entertainment Holdings. Amateur investors, a rising force in the markets, flexed their collective trading muscles this week, sending the seemingly unremarkable company stocks to new highs. The investors have cheered on one another through social media forums like Reddit's Wallstreetbets to buy stock and options in the company. This was on the basis that some well-known hedge funds had made public their bets that the company's stock would fall, known as short positions. As the stock skyrocketed, some day traders profited, and these short bets against the companies suffered losses. This dynamic created a short squeeze where heavy stock buying forces short bettors to buy even more stocks to limit their losses and therefore increasing the stock price even more. But is this recent mania a blip on the radar, or has it shone a new light on a new union of retail traders able to be mobilised globally at an instant against the intimidation of greedy Wall Street henchmen? Here to help answer the question is Chief Investment Officer of Sydney-based investment house Nick Morton, of Resonant, Nick Morton. Nick has over 20 years of experience in financial markets, including 7 years at Citigroup as a Director and Head of Australian Quantitative Research and 2 years at Colonial First State Global Asset Management within their $5 billion institutional equities fund. Nick's particular expertise is in quantitative finance, where he is an expert in conceiving, implementing and trading equities and the multi-asset models that incorporate the latest techniques, including macroeconomic, company level, and of particular interest today, of course, sentiment-driven metrics to deliver positive portfolio returns for his clients. Nick Morton, welcome to Nucleus Investment Insights.
Thank you, Tim. Thank you for the excellent intro. I'm looking forward to having a good chat about the last 2 weeks, fascinating events.
It has been, absolutely. Really looking forward to it. And here to share his thoughts on whether the GameSpot phenomenon spells game over for hedge funds, I'm joined by Nucleus Wealth's Head of Investments, Damien Klassen. Hello to you, Damien.
Hi, Jim.
Good to hear you. Good to be in the same room for a while as well, David. It's a nice
temporarily,
change.
Melbourne's just had a bit of an outbreak, so it's probably the last time we're going to see each other actually for a little while.
Yeah, it has. Yeah, it's watch and act, isn't it? And just a quick reminder that before we get started, if you haven't already, please subscribe and click on the notification bell to be notified of when we go live or have a new webinar to watch, or of course follow us on your preferred podcast platform. We also ask if you'd like to take a moment to click like on the video now to help our show grow. And of course, for those listening in live, feel free to drop in your questions in the YouTube live stream chat to have them answered along the way. Let's jump into it. So the agenda we have for today, we're going to kick off, of course, with the Reddit targets and the stocks of the day, GameStop and AMC. We'll then be looking from what's happened in the last couple of weeks to the future as well. So the future of the short selling industry, which I think are a little bit battered and bruised at the moment. Well, certainly a few of them are. We'll then be looking at some of the drivers of the recent mania. So looking at options markets, Robinhood and trading on the margin, the back office, I guess, of those organisations, so prime brokers and the financial market plumbing. We'll then be having a bit of a look at some ETF compositions, and there's been some interesting news there as well. And then wrapping out, as we do with every show, with our investment outlook and how we incorporate these themes every day here at Nucleus Wealth in our portfolios. So let's get the show started. I'm fascinated to hear it. I'm a big Reddit follower, and I have been watching the Wallstreetbets one with some zeal. But I'll hand over to Damien for the Reddit targets. We've got a couple of ripper charts up there, Damien.
Yeah, well, actually, I might. So we brought Nick on. Nick sort of wrote an article on Livewire Markets just about the GameStop and some of the issues behind GameStop, and I thought, given Nick's got a very similar I think background in terms of looking at the quantitative side, I wanted to sort of get a second opinion on some of these factors. And I guess for me, it's there's a little bit of moralising that I'm seeing everywhere in terms of every second article. It's like, it's the evil short sellers or the evil hedge funds or the evil mob chasing these poor innocent hedge funds out of the business or whatever it is. And I want to sort of try and step away from that a bit and actually get back to, okay, we've had some pretty significant dislocations in prices. What does this actually mean for markets going forward? and what changes are we going to see in options markets, in the amount prime brokers are willing to lend, and just volatility for individual stock that needs to be sort of catered in. If there is a chance that there's a roving mob that could descend upon a stock and drive the price up double or triple, does that actually mean that pricing then for a number of these other ancillary markets needs to actually change? And so with that, I guess maybe I should start. I'm going to pop across to Nick sort of for a bit of a background, I guess, on terms of GameStop, the fundamentals. So, I think it's probably safe to say that most hedge funds who are trying to short stocks are trying to find stocks that have got poor fundamentals and are having problems. And so, I suppose that's probably where you jumped in with your article, Nick. And if you were to give sort of a quick background, I've got a few of your charts up there on the revenue and net income of GameStop.
Wonderful, yeah. So I'm looking here at page 3, the GameStop fundamentals page. The first thing to point out, I think, when analysing the last couple of weeks, is just how divorced from, I guess, fundamentals of the company this whole event was. And that's not, in your words, Damien, seeking to moralise the behaviour of the retail mob. Far from it. What they did was actually quite rational in many ways, as we'll try and uncover further along in the podcast. But suffice to say that looking at these two charts, firstly on the left, you can see that revenues really peaked out in 2016, and that was almost, you could say, a temporary blip. Really, revenues became structurally impaired following the sort of 2010 period. It's a bricks and mortar company, and there's very little there to get excited about from a revenue perspective. Same from net income perspective. So it's been a hugely loss-making company in the last 2 years. It's actually cut its staff by around 50% or so, the full-time staff by 50% or so in the last couple of years. So there are some significant issues with this company.
And I think I saw the latest foot traffic was sort of down. I think December was down 30% or ish, sort of 25 to 30% on the prior year. So certainly it's not like there's a turnaround coming either in the short term.
There's nothing to get excited about, really. Certainly not that warrants a peak price of $480, which incidentally is something like 8 times its last peak, which is around 2016 or so, working from memory. So potentially the short sellers had overdone it. Maybe there is a little bit of a renaissance here for bricks and mortar, but certainly by this evidence, you wouldn't suggest the renaissance could lead to such an extraordinarily elevated share price. But I just wanted to point out, doesn't mean everyone's being silly here. There's all sorts of very good reasons why the stock's being driven up in the short term. It probably won't last in the long term, but what's fascinating is why a lot of this retail army can still be rational and yet not subscribe to the long-term fundamentals of the company.
Well, it's basically exploiting a technical. There's too many people have gone short the stock, and they've sort of a recognition that it's going to be very difficult for them to cover if the share price starts going too high, and then everyone sort of piles in and then it starts feeding on itself with this whole I'd sort of one of the ones I like to use is the idea of a price insensitive buyer. So if you've got sort of a market sort of with hundreds of people in there, and a third of the people are care about prices, two-thirds of people care about prices and the rest don't, is that every time you add a new buyer that's price insensitive, you've sort of got this core holding the stock that's not going to sell because they don't care about the price. They're just trying to bid the story up, and a short seller effectively then goes, so if we've got one price insensitive buyer, we add a short seller who actually goes out and short sells the stock and to another, say, price insensitive buyer. So now we've got 2 price insensitive buyers, but we've actually, the short sellers sold one. So the net demand for the stock is actually only 1 share. Whereas when you lose the short seller, they have to buy back their position. You actually go from sort of a net position of 1 to sort of 3 in a way, because now the short seller needs to buy back their position. and so you end up with 3 buyers, and so which is why that demand sort of just shoots up all at the same time.
And it really could have happened to any stock. The stock's just the vehicle for it to happen. But of course, it was a video game stock which resonated with the
could be Bitcoin, could be anything you want.
Yep.
It's just a matter of saying, oh well, actually, sorry, could it have been anything? I think that the major issue with this one, and I guess the point I've got on the next chart, just sort of showing there's a few stocks there. BlackBerry was one that sort of had a similar, 150% odd rise, or it probably rose even higher at its peak. AMC is there as well. There was one stock that's gone bankrupt. That was another one. I left it off the chart, but mental blank.
Nokia. I think Nokia was there on the list.
No, anyway, there's definitely another one as well that's gone bankrupt. So this isn't the only one, and basically what it is they've honed down and gone, okay, let's find some shorts. Let's find which stocks have got the most amount of short sellers compared to the amount of free stock that's out there. And for GameStop at one stage, it was over 100%. So, I mean, I think this GameStop has particularly captured the imagination of the social crowd. I think there is a reason for that, and actually, our view is that nostalgia is playing a part.
Yep.
And the nostalgia for bricks and mortar, because everyone in the Northern Hemisphere is locked at home. I talk to my 13-year-old son, who's far more adept at social media than I am, and an avid gamer, and he said to me, well, this has particularly captured the imagination. He didn't use these exact words, as you can imagine.
Did he use the words, I like the stock?
He said everyone loves the idea of going to a game shop. And the idea that this is completely broken is nonsense, because everyone's getting nostalgic for that whole world, given that they're just doing stuff from home on a computer for the last year and a half, and it's starting to bite. So there's that element, and that's why this has particularly captured the imagination of the crowd on Reddit.
Absolutely.
In our view, yeah.
Yeah, it's something it's a stock that's people have. They can see where they can see themselves shopping at that versus some of the more esoteric ones where if it's a chemical manufacturer or something like that.
Exactly.
It's very hard to. What do these guys actually do? I don't really understand it, and so
I can't see a coal producer in Australia getting the same sort of attention, right? Even though it's short sold.
Yes,
it's maxed out on the credit card. That no one is really. That's not really going to capture the imagination of the crowd. Potentially in some parts of regional Australia, potentially, but not globally in the way that this has.
Yep. So if we want to move on, so some of the short selling, I guess, I'll try not to moralise too much, but there's the short selling part. I think I sort of think of them in 3 different buckets. You've got your sort of fundamental short sellers who are there they're basically digging through, trying to find stocks that are overvalued and then short those stocks. And they're doing it with the view that they've often got a longer term take on this. And I think someone like the Bronte Capital, John Hempton, that he might have. I think he sort of has 20 or 30 odd stocks in his long portfolio and maybe 200 stocks in his short portfolio. So just sort of this broad spread of a lot of stocks that he thinks are overvalued, and they sort of hedge off, and they're there for longer term views. You've got a range of sort of leveraged ones who are out there, sort of hedge funds who are basically much more short term, sort of piling into this next trade and playing that as a long short. And then you sort of what you call your black hat ones, which is to sort of publish something, try and get a lot of try and get things out there to try and get share prices down, and then exit the position on very short. And they're probably the ones that the black hat guys probably make up the smallest amount of the market, but get the most amount of negative press, which is why when people hear short sellers, there's like, and the issue, I guess, from a short selling perspective is this idea of Keynes that markets can stay rational longer than you can stay solvent. Is that if somebody who's buying long makes a mistake and buys a stock and that stock halves, well, now it's a much smaller part of your portfolio and you don't have to worry about it as much. Whereas if you're a short seller and the stock doubles or triples, then all of a sudden it's much bigger part of your portfolio, and all of a sudden you have to worry about it. And and it becomes a bigger problem if it keeps on going. And so, so short sellers, I guess, in terms of positioning their size and everything, have this sort of fundamental problem or fundamental difference compared to ordinary investors. And so, I guess what I'm looking at it, and I'd be interested to hear your thoughts, Nick, is that I'm thinking that there was a lot of especially a lot of long short hedge funds out there. Is that most of them are probably going to be scaling back their positions and reassessing the risk. And so net, you're looking at a market where there's probably going to be fewer shorts in the market than what we saw before. But a lot of those are because they are long short, they're selling some stocks and buying, they're closing out, they're buying stocks to close out their shorts and then selling stocks to close out some of their longs to keep their net exposure about the same. And so the overall effect on the market, I don't think is going to be major.
Except, two things here. It's not just cutting risk on behalf of the manager, it's also potential outflows. Outflows and redemptions could drive buying back shorts and selling longs. So while I broadly agree the net impact won't be dramatic on the market as a whole, within the market, while this, if you like, liquidation of positions takes place, and sometimes it can be quite significant. I think second half of 2018 is the most recent period in which I can remember quite a significant liquidation of hedge fund portfolios, long short equity portfolios, and for those periods you can see quite I guess counterintuitive price action within the market in the short term, because you're essentially buying, to put it simplistically, you're selling good stocks and buying bad stocks. If you consider GameStop, and I would consider GameStop to be not a fantastic long-term opportunity, then you're buying it, and you will be buying other short positions that you're short to meet the redemptions that you've received.
Yeah, absolutely. That's that's a good point. There's and I guess it's the thing as well for in terms of there's going to be a lot more focus on this whole free float idea that which is exactly what the Reddit crowd sort of targeting, is basically going, look, where is the biggest concentration of short sellers, which tend to be the worst companies, and then get in and attack those. And the idea that if you're a short seller, you don't want to be the 100th guy piling into a short trade, because you might be just enough that now you attract the attention of a mob to come and push the price up and squeeze everyone. It's
quite an interesting one too, I think, where it's almost like, would you agree that there's almost, with the short selling sort of side of things now, that there'll be this sort of social layer that needs to be applied. It's like, okay, if we take this short position and it's made public, will the Reddit army be emotionally attached to this company, having bought some games or frequented a household name, and is this going to be something that's going to create a flare up? Or
it's hard one to do though. Like, I mean, Hertz was one of those ones that flew up and the thing was bankrupt. And you're like, true. Well, it's not like a new.
I mean, the answer for hedge funds, in my view, is to certainly on a short book is to manage a more diversified short book like John Hempton does, right? So. You can't just have a very small number of short positions, because these issues can flare up and create a negative 50% return. So make sure you're insulated from that, and overall, you're short a lot of broken businesses, just not concentrated in a particular industry, or it's just basic risk management exercise.
Yeah, but I think he would argue as well in his latest report, that he's having problems with just the number of, it's not, he's still getting hit on a lot of these stocks, and I think to your question, Tim, it's not actually about making it public yourself. You make it public. You have to make it public to the SEC, okay. And so they might not know that it's you, but they can see the aggregate amount of short interest, and that's the same in Australia as well. And that's
that'll drive the attraction to sussing out who's in there and mobilise the army.
Well, exactly. And one thing I think we should touch on is, what is cyclical versus structural in this whole episode. And one structural thing And I think that it's hit many other industries is the fact that you can mobilize an army quite effectively on social media. And 10 years ago that was inconceivable. And I think that is a structural change. So the idea that this is just driven by loose money and low interest rates, we believe is actually false. This has got more legs than that in our view. It's a reality that short sellers are going to have to deal with into perpetuity, regardless of whether rates are low, high, or whatever. In our view.
Yeah, but I guess the third part of it is if you're a short seller who makes it through this stage and you find that whatever it is, 50% of your market all of a sudden, 50% of your competitors disappear, or certainly in terms of size, then that probably does open up more opportunities and. And these things are all cyclical, I suppose.
That's right. By their very nature, they have to be cyclical to some extent. I guess the nature of the players has changed in that, you might be facing your adversary is not an investment bank or another hedge fund, but an army of price insensitive social media.
Yeah, that's right. Traders. And it's interesting in terms of that. It's pitched as this whole. David and Goliaths and hold on to these stocks and screw the Wall Street guys. And you're like, just a minute, guys, holding onto a stock that's just fallen 70%, you're not screwing the Wall Street guys. I find it entertaining that the guy who's one of the guys who sort of pitched this as deep effing value as his handle and sort of and had the whole story about, okay, I'm buying GameStop at whatever it was, $5 or $10 for these reasons because I think it's been overdone. And you can sort of see that, that is a deep value trade, and there's an argument behind it and all that sort of stuff. But then to hold on to that stock while it runs up to $400, and then still call yourself deep effing value, I'm like, that wasn't a value stock at $400.
Yep, absolutely.
Not by any stretch of anyone's imagination. And I think that whole idea that we're screwing you're screwing the hedge funds, and they absolutely did screw a bunch of hedge funds on the way up, but. The guys that are piling in and buying this thing and sort of going, isn't that funny? Let me go and buy this stock as well and help screw those hedge funds who are buying at $300 and $400. You're not screwing the hedge funds. No. You're actually giving money to the other hedge funds that have now shorted the stock and are loading up and are loading up on the way down because, as you said, I don't think anyone's looking upon this as something which is a long term. Yes, in a year's time or even 6 months' time, this stock's still going to be at sort of $400 or $500.
Nick, just a quick one. Notably, there's been a bit of commentary around how quiet the SEC has been on this whole thing. I think it's probably taken everyone by a bit of shock, and they're probably not the fastest moving organisation. Do you think there's going to be a regulatory response to this sort of behaviour?
I don't think there can be, to be perfectly frank. I think regulation of social media is nigh on impossible. The only could be that there are some large tickets running the show on social media and deliberately influencing a crowd, and essentially they will exit the position before they tell the rest of the world that they're exiting. I'm not sure whether that is completely against the rules. One thing that they could think about in the US is any stock advice. You need to be licensed to give stock advice, and like it is in Australia, actually quite prohibited really from giving company advice unless you're properly licensed. In the US, it's not the case. So that might be something that they might look at. But essentially, I think regulating social media is nigh on impossible because they can clamp out Reddit, they can clamp out Facebook. There was some other thing will crop up. So get it.
And the thing is, as well, like there's not like in the tech boom, there's some of these things about the hyping of stocks, and there's people coming in and putting out a lot of false information or just really pumping up the story in terms of this. A lot of this wasn't really wasn't anything strictly wrong in terms of saying if people jump in and buy this stock, if enough people jump in and buy this stock, then these shorts are going to get squeezed on it and won't be able to buy it back, and therefore the share price will go high. There's nothing factually incorrect about that, and in fact was proven true. So it's not like it's a if it's expressed in that way, it's just here is a fact about the market that's passing information to everyone. And
based on public information,
Exactly.
because absolutely. Here the battle lines. We've drawn out the battlefield. This is what we need to do. It's quite clear, and I think probably for those couple of weeks it was pretty well executed. You'd have to say for a short-term trade. So if given my experience over the years, and in some capacity, the more the short-term trading dimension, I would say that it was a shrewd strategy to exploit a special situation in the short term. I don't love it because it's
not adding value to anyone anywhere except for the people involved.
Exactly.
It's not as if we're saying we're allocating. If our idea as investors is we're here to allocate money to the best investment ideas, then
it's a horrible misallocation of capital in the short term.
Absolutely.
Absolute disgrace if you think that the financial industry serves to allocate capital efficiently in the long term to industries that have productivity gains and boost economies, and I think that's right. Then this is the complete opposite, essentially.
Well, let's jump onto this next part, because in terms of that execution part, I want to highlight as well that this isn't just that there's other things going on in the background, and the options market, what's being done now is relatively new as well in terms of exploiting what they're calling a gamma squeeze, and the idea behind this is that basically if you buy options, if you buy some sort of deep out of the money but quite short dated options, so which are highly likely to lose money.
So they're cheap.
And they're very cheap. Yeah. So you can buy those. But then if you add into that buying a bunch of options that are at the money, what you actually force the market makers, who are basically like a bookie, what you force them to do is actually go out and buy more stock, because they're looking at these. You've just bought a bunch of at the money options, and so they have to actually go out and buy the stock, so that they're not there trying to take risks. They're just trying to sort of hedge the market. And so it's this thing called a gamma squeeze, where that then forces them to buy it, which then actually pushes the price up enough that these other options you've bought, right? That's where you're going to make your real money from. And so
self-fulfilling prophecy.
Sorry, what was that?
Self-fulfilling prophecy.
Yeah, exactly. And so not only did you have the short sellers sort of having to buy back their stock in this one, you also had the options market and this whole gamma squeeze going on. And I guess what I wanted to posit on this front is interesting observation that in 1987 we had this huge stock market crash where everyone was sort of all in on this idea of portfolio insurance, and and that'd save you. And then the crash happened, and it was like, oh, actually, portfolio insurance relied on markets actually being open to trade, and when they gapped down, you lost it. And so structurally after that, the price of put options actually rose a lot, because people realised that, hey, these put options are really useful, because when markets gap down, that's where I get my money back on them. And the question for me is, it seems as if this type of action means that call options should be priced at a higher price, because the idea is that if I'm buying stocks and a mob could descend upon it and send it up 1,000%, all of a sudden means that the person issuing the call option needs to take that into account and needs to add some extra premium into what they're selling.
That's why it was clever, because really essentially the retail side of the trade was exploiting the robotic nature of risk management on the market makers' part. And so, because that behavior is predictable, it's I wouldn't say easy, but it's possible to exploit that predictable behavior to create profit. So the price needs to reflect the predictability of that behavior in a way. That's what I would argue. So Damien, I take your point in that essentially the call wasn't accurately reflecting the fair value that predictability of behavior, which is evident to the other part of the trade.
So
right?
essentially, there needs to be a Reddit Army premium added to all call options.
Exactly. Is you looking at these things saying, okay, this should be priced on an implied volatility of say 30%, which is what might be a sort of normalish stock of, I'm expecting it could be up or down 30%, and so that's my implied volatility that I'll pay for it. But I better make that 35% just in case the Red Army descends upon these stocks. Because if you're a market maker and you're doing this across every stock, you're sort of saying, okay, I'm going to make a little bit more money on every single call option I'm doing, and then I'm going to lose a lot on the one that the Red Army does descend upon, but I should make it up across the rest of my book. And so, what does that mean? So it probably means it is going to be harder for this to be done again. For that reason, is that the pricing of it will go. And the options market, I just want to say as well, the option market pricing during this was just crazy in terms of at points there, the share price would go up and some of the put options, which is sort of the right to sell, would go the opposite direction to what they should, because because the implied volatility was going the wrong way. So there was this point where even though you're sort of looking at a trade going, okay, you should have lost money on those options, but they're actually making money because the implied volatility was just shooting through the roof. And everyone was looking at these things going, that stock's not going to be $400 in 3 months' time. Yep. And so, I'm willing to pay way more than what it's intrinsically worth at the time.
Well, the short is reloading again.
Yeah.
Yep.
And that's, and actually this is a good example of why relying entirely on robotic processes to manage risk can sometimes be a downfall, right? So because ultimately, there's a few broad questions about this. Is that the right way? Are market makers managing their risk in the right way, or should they be thinking about it in a slightly less robotic fashion? I know that they're a little bit compelled to do so by industry norms and regulation, but it does raise a few interesting questions, this whole episode.
Yeah, and a lot of these pricing models are based on sort of log normal distributions of returns, and basically real life has fatter tails, and so that tends to be sort of marked into the pricing of these options. And I guess the thought is, okay, now they'll just have to make bigger assumptions about how fat the tails are going to be. But let's go to the Robinhood one as well, because so what I'm doing is sort of walking through that. This is sort of exposing a number of different flaws in terms of the way markets are done, and I think this whole incident to me is it's just sort of peeled back the skin a little bit on a few different sort of issues. And so the Robinhood bit, just for anyone who hasn't seen it before. And it's not just Robinhood as well. There are other brokers out there that were very similar. It's just Robinhood was the biggest, and so the most, and got the most news about it. So Robinhood basically you can trade for free on it, and I've just sort of put that quote. When the product is free, well, you are the product. So when you're trading there, they're basically then selling those flows onto hedge funds, and
just on that, they made it very, very easy for people to get into things like options. So it's sort of like, game. Do I buy the stock or do I get 10 times exposure to the stock? I'll take the 10 times, please. I like the stock.
Yeah, and the whole app is designed to be like a game.
Exactly.
It's like
gamified.
It's not like you're playing with real money. It's just playing with this, these tokens that you've got, and it's, enjoy yourself, Tim. Yeah. And the thing is with, and also then they lend the stock out to short sellers. So it's sort of that thing as well that like they were. So in the end, they were getting the stock and getting the GameStop stock and then lending it on to short sellers as well. So they're making money on that. But one of the key issues is they're actually trading on margin accounts. And the issue with that is, so Robinhood is actually the owner of the stocks, and it sort of flows through to they've got like a beneficial ownership goes through the end holder. And so when everything went haywire and these stocks started rising up, Robinhood sort of cut back on what they would actually let people buy, and that's where we got all this political involvement of people saying, this is terrible. It's you're standing up for the hedge funds, and this is Citadel doing stuff, and hedge funds. I've called it hedge funds with their finger on the scale, forcing Robinhood to not allow these trades. But the flip side is, because of the way they're trading, they have to make sure they've got these capital buffers, and they've sort of put these capital buffers in there saying, okay, if somebody buys the stock on one day, there's a few different places where people could lose money in terms of not fulfilling orders and issues with options, and they have to put a bit of money on account. And it's one thing when you've got a traditional stock which has got sort of a 30% volatility, but when GameStop's sort of like an 800% volatility or more, then all of a sudden they actually needed to put all this extra capital down. Basically, the prime brokers were coming back and saying, well, because all this thing's so volatile, if you want to trade these, and so they raised about $4 billion in order to being able to cover the side of it. So it's this issue about, and I'm sort of trying to sum it up the bottom, but so at a headline level, everything looks fine because I've got a bunch of people long and a bunch of people short, and the whole thing ends up being fine. But at the micro level, if you start seeing defaults fall through, there's a bunch of chains of these, and that's what sort of happened with Lehman Brothers, where you take out one person and all of a sudden nobody knows what could fall over, and you get this big scare. So it didn't happen this time, but it wasn't that far away, I suppose.
No, but in fact, insolvency would have been of Robinhood would have been catastrophic for the Reddit army on many levels. Absolutely. And so while at first we had both Democrats and Republicans quite rightly disgusted with Robinhood and whether this was I think obviously Citadel have a strong relationship with Robinhood, and whether there was Citadel's involvement and so forth, and they were protecting their business relationships. But it's quite apparent, I think, that they were really protecting themselves from insolvency last Thursday when they limited trading on some of these names. And for the Reddit army, it actually was a good thing that they weren't insolvent. So
well, and preventing you from buying in at a $400 share price, you'll probably be happy about in a few months' time, rather than saying, no, I missed my opportunity to buy GameStop at $400. You're saying, well, how would you like to buy it back at 20?
Yeah, exactly.
So well, and so it's that, I guess what I'm looking at is maybe there was something nefarious behind it, but there's quite likely that it was actually just a genuine need for capital, and the fact they had to raise $4 billion, I think, is a pretty is a smoking gun to say, well, this was a genuine need for capital. It wasn't.
It looks that way to me. It's hard to tell. Maybe there was something nefarious that we can't see, but from everything adds up to a capital issue last Thursday. In my view. Yes,
and it's pretty hard if you're a Robinhood guy to say, well, I want my money back on my trade. It's like, well, you didn't pay for it, so it's obviously a lot harder to complain. Yes,
very good.
And it goes into the other issue with social media and with essentially seductive conspiracy theories, and I think there were quite a few fanciful seductive conspiracy theories floating around on Friday, look, it's just a fact of life, I suppose.
So actually, I missed the final step of the options one as well. Actually, saying what does that actually mean for the options market going forward? And I guess the thought to draw that into the longer term before we do the Robinhood, what does this mean for the market going forward? I guess I look at the options market and go, okay, that's actually probably going to take a little bit of leverage out of the system, in that call options could be more expensive. It will be less likely to have those the runs, and so I guess what I'm thinking is it probably takes a little bit of the upside out, but on the flip side, I think it actually creates a fair bit of interest for retail punters to go, hey, look at all these guys made so much money on
the options, on the upside.
On the upside on GameStop.
Yep.
Maybe I'll try that on whatever the next stock is, or the silver, or whatever. Pick your next one. But I guess the idea is then they're not price sensitive, these people who are buying the options anyway. It's not like they're sitting there going, oh, geez, I'd buy this, at a 30% vol, but I'm not going to buy it at a 40% vol. They're just going, I'll take the option. Give me a short-dated option and tell me what the price is. Yeah,
they're buying lotto tickets.
That's
right. Exactly.
And when you look at some of the posts, I mean, they're very seductive. A lotto type win payoff is hard to find anywhere, and now this actually
concrete
gives
proof
people
of a lotto payoff.
Exactly, and to be honest, a lotto payoff would change my life, personally, and I think everyone can say that about their own lives, and that's the seductive nature of it. Yes, precisely.
And also the idea behind, I quite like that theory behind lotto tickets as well, is saying that, well, when you buy a lotto ticket, you're not sitting there and going, right, I have a 1 in a million chance of winning $500,000, so that's a bad bet. Whereas a 1 in a million chance of winning $10 million, yeah, okay, that's a good bet. Nobody's doing that because part of what they're buying is actually the chance to dream for a bit. Is about saying,
Yes.
yeah, I've paid my $1 for my lotto ticket, and now I've got it's a $1 chance to dream about whatever I want to dream, my daydream, and when I lose, it's like, oh well, that's all I did was bought myself a daydream, and maybe there's an element of that in some of this pricing as well. Is I've put $1,000 or I've put my $1,400 check from the government into the
biggest loser out of all of this is casinos and sports betting, maybe.
That's right. And I think the other thing too with the sort of Reddit army movement is becoming part of something as well, I think, and so you've got the armchair experts and people, sitting in their mum's basements with their hot stimulus check, and it's like a new age bikie gang, financial bikie gang. You can put your money in, put your diamond ham symbol up on the thing, and be part of the movement.
And we look at how we stuck it to Melbourne Capital or whatever. So
that's right.
Yeah. So then the next thing for the longer term for Robinhood, so there's a lot of negativity came out of Robinhood. I sort of feel like there was a lot of positivity as well that came out of it, and there's actually spoke about how many new accounts had all been set up on Robinhood,
and the revolt from Robinhood.
And there's a bunch of people leaving, a bunch of people coming. I suspect the people who are leaving are probably just going to end up at another. Yeah, they're going to flip from there to Charles Schwab or to somewhere else, and so I guess I'm not sure that it ends up being a net negative for the market in terms of money leaving the. I think it's more likely just to actually attract a bit more money, a bit more hot money in terms of we need to see some big losses before the hot money starts disappearing. I don't know, Nick, what you're thinking?
No, I agree with that. I think it's actually, like I say, this is really quite seductive for a whole audience of people that probably thought finance was a bit dull. Suddenly, taking a huge interest.
Stick it to the man, make a couple of $1 million.
Oh, look at just the timing. You've got hundreds and hundreds of millions of people in first world countries that have got more money than they normally do because they're not going out and spending any. They're stuck inside. They've got the internet. They want to feel part of something, and all of a sudden this pops up, and they go, "Okay, well, let's have a look." 101 options trading. Let's have a look.
Yeah. Okay. So
the other dimension of this. I don't want to labour too much, but also is obviously with wealth inequality on the rise. Just that the need for a lotto win to have a lifestyle comparable with the top 1% is, I guess, more of a pressing need potentially.
Yeah, I can see that. I mean that's. I can't remember where I saw the research, but there's something along these lines of this research on people trying to save for a house deposit. I think it was actually in Australia as well, when house prices were booming back in the sort of 2000s. And they're basically saying the most likely thing they did when the house prices kept going up and moving out of control was they went and bought a new car with their house deposit, when they just sort of gave up, just went, okay, that's it, I'm never going to have one. Let me go splurge it on something. And it's that idea that if something keeps moving out of reach, I've just got to
go and do something else.
Let me just gamble.
Feel those wanting emotions.
Hard saving it to get it up to whatever level. It's just like, gamble it and hope it comes out. Okay, prime brokers. I only want to touch quickly on this one before we got to the ETFs as well. So the prime brokers are the guys who are basically lending the money in this, and I think and providing the leverage to especially to a lot of the hedge funds. So Melbourne Capital, one of the biggest ones on this, was down 50% in January, which is a fairly big hit to take to a portfolio. I think it's hard to see if that's ever you can come back from that.
What's that, annualized?
Yeah, that's right. So I guess the question for me is, does this mean that prime brokers are going to start scaling back on their risk taking and take some leverage out of the market? And I'll sort of throw that across to you, Nick. See your thoughts.
Potentially it has repercussions throughout. But I would say that overall, probably, these large prime brokers are sufficiently diversified that it wouldn't be anything more than a flesh wound, really. Of course, there'd be some winners and losers. I know Melbourne Capital lost a lot, but there would be some hedge funds that have made a lot as well. So I potentially, look, I haven't probably thought through the prime broker repercussions as much as you have, Damien, but basically, I'm not I'm not entirely convinced it's too damaging. Yeah, but they may charge more, absolutely, on short selling.
Yeah, I guess I'm just not sure. I guess the one I'm looking upon, where are the potential negatives, and to me this one is the biggest potential negative I could see is if prime brokers came back and went, you know what, we've redone our risk models and all these hedge funds have to, we're only going to we're going to lend you 10 or 20% less than what we were lending you before, which I'm not sure is going to happen. But I guess that's the one thing.
Which would have a giant size impact on the market.
Exactly.
Yeah.
Maybe they're the ones that instigate the free float percentages and things like that. They keep a bit of an eye on the, and they go, well, if it's getting above 50 or 60%, we're starting moving to Reddit Army territory.
Yeah. and look, the thing as well is I think they certainly see themselves having a central bank put, and there's low rates and they've got short memories, and so and as long as nobody got too badly damaged, which doesn't seem like anyone got. I mean, if all that came out of it was Melbourne Capital, had to be wound down eventually, I think they'd probably look upon that and say, "Oh, well, that's fine. That was fine. We can lend more." I don't know.
But they're very well capitalised, the investment banks, especially in the US at the moment. Also, the prime brokers, I think, are a bit less robotic about managing risk. So I wouldn't be surprised if they're already scouring Reddit on a daily basis to find any weak spots, and probably trying to address it proactively.
Right. Yes.
Interesting.
Yeah. Okay. And the last one I just wanted to highlight. This is I guess a more of a minor one, but it just the. I just want to highlight because I think a lot of people look at ETFs and say, yeah, I've got an ETF, I'm safe. But I just wanted to highlight that there's a few ETFs. So a video game ETF was the top one. Sort of ended up GME was 33% of that fund, which you probably wouldn't have been expecting. But the S&P retail REIT, which was actually an equally weighted REIT, ended up being 22% because the rise happened so quickly, and it was before its next rebalance. If you were buying it at the peak there, you were getting a hell of a lot more GameStop than you probably would have thought. And if that stock's falling 70-80%, then that's a big hit to take from your portfolio. So I guess it's the idea that we've sort of spouted on here a few times is that get some smart beta ETFs where they've basically set the rules, and that's what the rules are, and so that's what you're buying, and so you just need to be a bit careful about what's ending up in that. And so and the third name on that list I've got up on the screen is probably the most worrying one, where you're saying you're buying a small cap value portfolio, and you're buying what I would have thought was one of the most expensive stocks in the market at the time, because yes, it was a value stock 3 months ago when they last did their rebalance, but now it's up 1,000%. It's no longer a value stock, but it's still in the portfolio, and it's not going to get rebalanced for another 6 months.
Well, it might be good value again.
So that's right. In 6 months' time, might well be good value.
So we always think of ETFs as a precision tool. So this is a great point that you raise, actually, and not one that I thought of. But you think of ETFs as a precision tool. So if I'm buying a value ETF, I think I'm getting a value basket of stocks, and I'm going to be exposed to value. If I buy that today or last Thursday with GameStop at $480 and it's in the portfolio,
16% of your portfolio.
Yeah.
Exactly. It's not a precision tool at all anymore. But maybe that's a good thing for active managers versus ETFs.
Oh, yeah.
Who knows?
Yeah.
Yep.
And we were talking actually just a little bit off air as well, and I've spoken about it a few times on here. It's just saying that quant factors at the moment, because all the numbers are so screwed up, we're sort of we've got two models. One is a normal model, and the other one that excludes 2020 and 2021 numbers, with a view then say, well, just if I think this is a quality stock or a value stock, let me just exclude these 2 years and see if it still is a value or quality stock before I then go and make a trade on it. And a lot of these ETFs are all backward looking, and so what you're seeing is what happened last year, not what's going to happen next year with all of them.
So some of the pain trade could be on index providers.
Yes,
potentially,
yeah.
Longer term. So if this sort of absurd price action continues, persists in markets, then there could be a spotlight there on index providers.
I'm just fascinated that the rebalances are so spread out. on these sort of ETFs. Going back to your point, Nick, with the precision, you would have thought these metrics, if they're sort of reasonably well, they're calculated.
Most do quarterly, and actually a lot of the MSCI ones have like a semi-annual big one and a quarterly like a little one. So they're not.
Yeah, as an ex MSCI alumnus, it's too challenging to rebalance much more frequently than that. To be frank, and that's not the nature of the beast, So it's within most people's expectations, but I don't know whether investors buying these ETFs understand the underlying mechanics of indexing as well as they probably should.
And I guess it's most likely to happen. You're most likely to see this happen in small cap or particularly niche ones. I guess is the message.
Concentrated ETFs, especially, and we've steered clear of those for that specific reason in our own process. Even some thematic ETFs. Some of the themes are very, very good, very, very intelligent, very forward-looking, and so forth. But if the portfolio construction is overly concentrated, you may not be buying what you expect to be buying at different points in the cycle, depending on whether you're exposed to one of these particular names.
Absolutely. Okay, so I've got a few what nexts. Silver. So that was and I guess I just want to highlight as well. So it's been sort of pitched that silver's the next one. The army's going to descend upon, and they've had a bit of a go, and it didn't really work, and prices have coming off. But I just want to highlight as well, this isn't like it's not like well, it might be described as a Reddit army. It's not as if there's commanders that are saying this is the way we're going to go. It's charging. There's 50 different people all suggesting this is the next best direction, and some will go in that direction and some won't. Like it's not sort of a, and so I'd be interested to see what do you think they could do? What do you think they could do it to silver, or is it silver market too big?
I don't think it's possible. No. And I think actually it's not going to capture the imagination quite to the extent that GameStop has. Yep. Is my view. I never say never, but to me it looks unlikely. I'm not sure about what your thoughts are.
Well, I look upon the arguments, and so I read some of the silver pieces, and they were quite, they're well written and quite compelling in terms of the grains of truth, I suppose, that are there. I think the thing for me is, I sort of feel as if I've seen in the gold market, that's a lot of the same arguments trotted out for years. If everyone just held this much and whatever it is, and if you look at the silver to gold ratios, and you look at, there's a whole bunch of stats you can come up with that have quite compelling for why, these things should be much higher priced or whatever. But the net effect is, silver's a very expensive metal on its own compared to any of the base metals and things like that. It's not a very widely available. Like it's more of a byproduct from other ones. So there isn't a lot of supply that's going to come on. Mm-hmm. But the flip side is you've got to convince. You've got to come up with a meme that convinces everyone. And I sort of feel as if the market's big enough that you're probably going to struggle to get that initial momentum going that then attracts the more momentum. So because if you can get it up 20, 30, 40% in very quickly in early days, then more people start piling on, and more people start piling on, and people start covering their shorts, and the options start, and off you go. Whereas I just sort of feel as if the silver market's big enough that that first sort of 20, 30% to attract the more attention, I think is going to be tough. And but as you said, never say never. If you can, if it's about what meme's going to pick up, isn't it? And nobody really knows what meme is going to take off, and so maybe it could be.
I think that the concentration, the sort of portfolios that are running, underweight positions on silver and so forth, probably a different kind of strategy from the typical GameStop short portfolio, and I think that's key. The enemy in this case, if I can call it the enemy, I don't think it's the enemy, but that's a little bit of Reddit language for you. But the enemy on the other side of the hill is actually looking quite different to the GameStop enemy.
Yeah, and potentially as well, you sort of they might not be all pushing in the same direction as well. If you've sort of gone short silver, long gold because you expect them to narrow or whatever, and this trade's actually pushing silver up and it's pushing gold up because there's a bit of flow back from other people buying gold as well because it's I guess what I'm saying is
Yes.
you might not find it's the pairs trade might push you more in that direction, whereas
just one thing on that as well, though. I think I don't know the stats, but I think it's like 90% of the subscribers to the subreddit Wallstreetbets have been stacked on in the last couple of weeks, right? So it's watered out the effect now, though. It's not a private group of 1 million or 2 million people or whatever it was. Globally mucking around, playing with investments and options and posting, win porn and loss porn and all the stuff that they were doing, and now there's 10 million or whatever there is in subscribers, most of which are in the financial service industry, building bots to scour their feeds
exactly,
and build trading algorithms off it. So I think it's almost the death knell of Wallstreetbets being the community that it was. So they've sort of shot themselves in the foot a little bit.
There is questions about whether there's professional traders in there who are basically feeding the stories.
Oh, of course, and now it's rife though. Yeah, back in where they I think the community could sort of quell a lot of that in the earlier days. Now it's almost impossible, like how
I can see series 6 of what was that show called, Billions, on Netflix, focused on this
onto Reddit,
and where Bobby Axelrod has specifically someone on Reddit fueling purchasing or pushing up someone else.
I need to get out of this
rival
stock.
short.
Go and write a buy story so I can get out, or vice versa. Yeah.
But on the other hand, even though there'll be a pile of institutional interest in Reddit, I still think this is here to stay, and I think that this dynamic will not just be arbitraged away successfully because it's just going to be too large, and the potential lotto type payoffs are just going to keep people flowing in. So, my view is this is not getting arbed away.
Yeah. And I think I've sort of written this last slide. I've got just a few of the things that it. So we spoke about the option pricing and gamma squeezes and how that'll probably be a bit less, but it's still there. There may be some more margin requirements, so that might take a little bit off the heat of this, but it's still there. Maybe there's a backlash to Robinhood, but maybe there's more people out there trading. So the net, and I think one of the things that I think is a little bit lost in this that I sort of alluded to a little bit earlier, but with that whole idea about excluding 2020 and 2021, because the numbers, when everyone looks at numbers, they're like, but those numbers are depressed because of COVID. It means that fundamentals are difficult to assess, which means that people stop doing it, and they just go, oh well, there's all this money floating around. I'm not quite sure if that's cheap or not, but I'll just buy something. And whereas I think in a more normal situation where you can look at the earnings and go, okay, that's the earnings they've had for the last 4 or 5 years and they're gradually growing it, I can see it's not worth whatever it is. But when you're looking at the stocks and you can say, well, but the earnings are down because of COVID and they're going to bounce back once everyone can go back to shops. That's sort of that whole
People
part.
are anchoring on technicals rather than fundamentals.
Yeah.
More so than they have been traditionally. And that to me is quite a tricky market, and because of the uncertainty, we could easily face a large drawdown the next couple of years for that reason. I'm not saying it's going to happen. I'm just saying that tail risks on both ends are amplified as a result of quite a woolly kind of forward-looking situation.
Yeah, and so I guess my summary is I don't think this marks the top of the market, but I think it's a sign that we're getting close. Like when you get close to the tops of markets and heaps of liquidity, you start getting weird stuff like this going on. And as I spoke about, it's uncovering a whole bunch of things that aren't quite working right in the system and ways that people can game it. And so it's sort of that sign of too much liquidity and lots of people with lots of time on their hands.
The digital shoeshine army is starting to rise up.
But I think Tim's got a few questions.
Yeah, a couple of questions come in. And just for all those that are listening in live, feel free to pop in some questions now if you've got anything on the tip of your tongue you haven't typed out yet. Got one here. We're sort of probably talking what's next as well. Does this mean zombie companies potentially have a bit more life if shorts are less likely? And how big is the impact on shorts on zombie companies? Thanks, Garden of Whedon, for that question.
I
Nick?
can start.
Sorry. Far away, mate.
Sure.
Yeah, sorry.
So, Zombies got a new lease of life essentially in March with the Fed rescue package, buying corporate bonds and so forth. And I think we've seen bankruptcies almost suppressed at 20-year lows in Australia as well. So I'm not sure that. I think the lease of life came from the central bank policies and government policies, more so than an absence of short sellers, to be perfectly honest. So I think the key there is the stimulus.
Very good. Yep. Damien?
Yeah, well, and it's that part where we've spoken about trying to bail out, that bit about the bankruptcies and central banks stepping into credit markets to actually buy credit. Not that they actually did much of it, but the fact they've said they will do that, I think
the signal was really important. Yeah. Sorry.
And that sort of leads to all these ones where we've got bankrupt companies that people are out there trying to buy because they're whether it's Hertz or other ones where it's this idea that there's no downside to these things, that the central bank's got your back, and so so I think from the perspective of zombie companies, there'll be lots of them for the next little while, and I think I don't think the short sellers are going to put them out of business completely themselves. I think that it'll help. It obviously makes a difference,
doesn't it? Yeah,
it makes a difference to raising capital. But the reality is, most of these ones were going to really struggle to raise capital anyway in any meaningful amount. If this gives them a bit of a lease of life, so we saw Hertz trying to raise capital while they were bankrupt, basically telling people in their prospectus that please give us some money, and by the way, you might not get any of it back. And then the SEC made them pull it. But you can see where there'll be other companies that are in a similar position. If GameStop had decided to pop out with a capital raising for a few $1 billion at the peak there, maybe they would have got the way and without actually going broke themselves. So I think for zombie companies, and that's the danger for short sellers now, is they can do all this research and find companies that are going to go broke, but if you happen to be on the wrong side of it when the internet army descends, then then you're going to lose out.
Look out. Very good. All right, shall we jump across to the investment outlook? Just mindful of time here, Damien.
Yep, sure.
Dancing but near the door has been a pretty persistent theme through the last few shows.
So I think it's just one more sign that those positive factors are outweighing the negative factors, and that the amount of liquidity. I guess we've been pitching it very much as we're in this market that's driven by central banks and governments, that they're preventing bankruptcies, writing checks for people without work, and sort of really trying to just sort of keep everything going until we can get a vaccine up and running. And given the vaccine, so before the vaccine news, we sort of thought, well, after a year or so, governments will start winding it back. But once we saw the vaccines and the idea that governments, if they're going to extend it, it's probably only for another 6 months or 12 months. And so there's this desire to keep extending the stimulus until we can see the population vaccinated, and then sort of move on to the next step. And so so for the investment outlook is sort of, it's keeping some equity exposure, but a close eye on the exit. And I do think there's an element. So in our latest report, we wrote a lot about the disconnect in pricing, where if you look at the most expensive stocks in the market, they are really expensive compared to where they've been historically. So the top 10% of stocks are trading on sort of 50 times profits, 2 years out profits. This is not if so beyond the crisis. Whereas if you look at the bottom end and the cheapest 10 or 25% of companies, they're not that historically expensive. Like, they don't stick out as being, hey, they're way more expensive than they have been. And so we saw when the financial crisis, when the 2000 tech boom finished, that you had this part where the NASDAQ fell 30-40% and value stocks actually rose, and the S&P 500 was roughly flat for about the first 6 months before you started seeing the economic impacts, and then the whole market fell away. And we're expecting a similar scenario where there's going to be rotation, but there's certainly opportunities to make money in these markets still, but with a lot of risk controls and a close eye on the exits. And actually, it'd be interesting. Actually, that's our side. Nick comes from sort of does this very similar to what we're doing, but I'd be interested in getting the
quantamental view,
the quick version from you. I guess how you guys see the market.
If you'd like to share, Nick.
Sure. Not too dissimilar, actually. We're constructive on growth assets, whether that's domestic or international. Probably incrementally, slightly favouring domestic. More so than we were, say, 3 months ago. We think, the outlook for Australia is actually pretty good, given, the virus management and so forth. But we're across all of growth assets, we do have one eye on tail risk, which we think is kind of amplified. And, we've really positioned the portfolio to manage that as well. So it's a bit of a barbell at the moment that we're operating our multi-asset portfolios, but there's certainly things to be optimistic about, and the vaccine is hugely positive news. We're probably not as constructive on international travel as some other commentary has suggested, because if you've seen the political environment for coronavirus in Australia, is pretty toxic. So any case and borders are shut, and so we're just not convinced that international travel is going to be easy, and that has repercussions for airlines, education, and so forth. So
that's interesting because we're sort of on the other side of that one. So I guess and so I'm interested to see. I guess we've taken the view, and I don't think anyone knows this, so I'm very interested in where you think we might be wrong, is we've taken the view that at a certain point you get enough of the population either vaccinated or having been offered a vaccine. So let's say we get to, 70% of old people and 50% of the rest of the population are vaccinated, or 40% of the rest of the population are vaccinated, but everyone's had the opportunity to be vaccinated. I guess what we're thinking, Australia might be different, but certainly internationally is at that stage it'll be like, well, we've protected our hospital system by vaccinating most of the people, and the people that now get sick are the ones who've chosen not to. So it's their own choice. Say the US and Europe, we're throwing our borders open. I think that'll probably be Australia. I've got less of a. I'm not quite as sure in Australia, but I suspect so. So it'd be interesting.
I think I completely agree. Globally, particularly Europe, US, absolutely. People are champing at the bit to travel. I'm thinking specifically about Australia, and I think because almost managing this crisis well is almost going to make it harder to transition. Exactly.
Yeah, that's right.
So I think people are scared, and I think that politically it's poison to have more than 5 cases. I mean, you saw what WA did in the last couple of days.
Yes.
Queensland and so forth. So there's no political capital in taking risks with borders. I mean, you can actually suggest that there's been political capital in keeping border protect exactly for
Absolutely.
a long time. So this is really no different. So I think the transition for Australia to full foreign travel is going to be harder, perversely, than the rest of the world.
I think you're right in terms of it being harder. I'm just not. I don't know. I guess I'm expecting a flip at some stage where it's like, well, everyone else is traveling. How come we're stuck?
They will definitely come, and but I don't think it's the back end of 21. I'm thinking more about late 22.
Just on that, actually, just one last question for me on that travel theme was travel insurers. It'd be interested to, I think, following that similar thing though. And if I just sort of frame it in such a way where, travel insurance is I wouldn't say it's optional, but it's sort of one of those things that you can and cannot have. Going forward from now though, it'll be saturated. 100% of all trips, of all things that have any sort of risk in them, I think would be a safe bet to say. I know, like even just personally, and going from the point that obviously what's happened over the globe, almost everyone now has had some travel plans affected, or they've had to think about it. And so then insurance, is there a value play in insurers that are probably bleeding at the moment from revenue? Having their doors, stampeded in with clients and revenue once everyone gets up and going again.
Yeah.
It almost becomes automatic.
And I guess your flip side is maybe there's something where you find developed countries might say, I tell you what, if somebody comes over here and gets COVID, we'll treat them, and as long as you treat our...
Oh, right, yeah. We'll treat you in our best hospital.
Well, I don't know. Yeah.
Well, I think that's a lovely thought.
But probably not going to happen.
Yes.
Treated in our best fluffy wall hospital.
I guess the thing is you need to be vaccinated. I think you won't be able to travel unless you've been vaccinated.
Yeah,
I think that'll be
that's
the key.
where
Is basically
it'll
going, don't even...
Or you won't get insurance unless you're vaccinated.
Yeah, exactly.
Something like that as well.
Yeah,
Anyway.
that's probably a better way, isn't it? Saying yes. Would you like to pay, $100 for your travel insurance,
or $1,000,
or would you like to pay $1,000 or $10,000 to be uninsured? But do it without a vaccination. Yeah.
Very good. All right. Well, look, mindful of your time, Nick. Thank you so much for coming on. Would you like to share with our audience ways that they can follow some of your work and get in touch with you, and perhaps even an ideal client for yourself as well for those listening in?
Yeah. No, thanks. Firstly, thanks Tim and Damien for inviting me on the podcast today. Very, very enjoyable indeed. So Resonant Asset Management, so we're a specialist multi-asset managed account provider. So our clients tend to be advice practices, and essentially we construct bespoke, tailored portfolios for advice practices, conforming to their asset allocation ranges and so forth, APLs. We're currently available on a variety of platforms, chief of which is Net Wealth, and you can track us or get in touch. Details are either on our website, which is www.resonantam.com.au, or on our LinkedIn page, Resonant Asset Management LinkedIn page, or connect with me directly. So Nick Morton on LinkedIn. I'm not on Reddit, unfortunately, but it's probably something I should look into.
Come on, Nick. Come on. You've had a couple of weeks.
And I'm not on Twitter, but because I tend to talk too much. So, but feel free to get in touch. And I love having conversations with whether you're a financial advisor or you something interesting on the podcast. Feel free to reach out. I love talking stocks and markets and all things investments with all participants.
Wonderful. Yeah, look, and fantastic chat today. In the words of Candy Flip Records, one of our viewers, Nick is a great guest, well thought out and clear comments. Thanks for having him on, and wholeheartedly agree with that one. So thanks again for your time today, and we do look forward to getting you back very soon, Nick.
Thanks very much, guys. Wonderful.
Excellent. All good. Okay, we'll roll into our viewer question of the week. So what's next for the Reddit retail army? Is it silver, or is that a red herring? Where do we think that the army will mobilise next to fire that one up? We look forward to your comments in the comment box on the YouTube channel. So please feel free to drop them in there. Coming up next week, we have, of course, the bull case for equity in 2021. We did promise it this week, but of course Nick came on, and we thought we better get him on board to chat around GameStop. But with, of course, the bull case, with markets already at stretched valuations, the fundamental alarm bells are starting to ring that it could be the top of a normal market. But is it a normal market? By all accounts, most say no. With the pandemic still in full swing in most major economies and the requisite waves of stimulus to come, how much longer can this unique bull market be expected to continue? So tune in next week, Thursday the 11th of February at 12:30 p.m. to find out why you should hold stocks in 2021. Thanks again to all of those who have watched in live for another great episode, and all of those who have asked questions and provided comments. I hope you've taken away some great ideas, and if you haven't already, feel free to click like on the video to give us some feedback. And of course, if you'd like to see more of our content, head over to nucleuswealth.com/content to stay up to date on news from us. Follow us on social media. And finally, if you know anyone that would get anything out of today's episode, let them know about it. Share with a friend on Reddit, perhaps, and help our show grow. Thanks again for tuning in from myself, Tim Fuller, and the team, and we look forward to catching you at the next one.